Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about what information you should be taking notice of in the media and what information might make interesting reading, but you shouldn't let shape your property investment decisions. According to the media, not more than 6 or 7 months ago, investing in property was no longer a smart way to build wealth. You know, Labor wanted to ban negative gearing, increase capital gains tax. Commentators were predicting that the market would crash by more than 20%. Banks were tightening lending standards, and so on and so on. Since then, I guess the world to some degree has returned back to normal, and most of these concerns have abated. And according to the media, property is now again an okay investment. So it shows, how the tune of media can have a great impact on, what is ultimately a good long-term investment, or at least can be if you get it right. But what if Labor had have won? Well, of course, the fact that they lost the election in May 19 certainly helped the property market, because it meant any changes to negative gearing and capital gains tax were off the table. However, had it won the election, even if it had won the election, I doubt Labor would have been able to get the proposed changes legislated, particularly in an environment of struggling property prices. And even if they did get them legislated, I stand by my view, which I expressed a number of times leading into the May election, that whilst these changes would have materially reduced after-tax returns, that it wouldn't have rendered property investment uneconomical. In the long run, investing in the right asset, the laws of supply and demand still would have delivered good quality returns, and it would have been a viable investment. I was reading an article by an investment manager that I respect greatly a few weeks ago, and his thesis was that it was too early to call a recovery to the property market because of a fall in construction volumes. And he went on to explain, that is construction of new dwellings. He went on to explain that a depressed construction market will create negative consequences for economic growth. Construction companies going out of business, lower employment, and there's flow-on effects to suppliers, to the construction industry, and so forth. And therefore, that'll have negative consequences for the property market. And whilst I don't disagree with the author's economical rationing, I was really sitting there thinking, well, that's great, makes it interesting reading. It's true, I don't disagree with it. But how should an investor react to that information? So if I'm contemplating, for example, investing in a blue chip investment grade location, do I really care about the fall in construction, which is inevitably in locations that are geographically far away from investment grade locations? And whilst it might have a macroeconomic effect, if I'm investing in a property for 10, 20, 30 years in a location that's not really driven or influenced by the level of construction, do I really care about this? So I started to then think about, well, what are the useful topics that the media can talk about that I should listen to? But most importantly, what other media noise other than that? What should I be blocking out? Because you want to be really careful about what you're consuming in terms of information, because it can even unconsciously shape your investment decisions. So be really careful in respect to that. So in reality, the media really only are interested in articles that are newsworthy. And by definition, newsworthy means that the information, the topic, the story, the thesis is time sensitive. It's about the now. So it's either what happened yesterday or what we think is going to happen tomorrow. So it tends to be very short-term driven rather than long-term driven. And because of that, I don't think it's often very useful to investors. So before we talk about, what are the key things at a macroeconomic level, let's remind ourselves what a good and bad investment property looks like. Because, if you go and buy a good or bad investment property, the cost to hold that asset are largely going to be the same. You're going to pay the same amount of interest for a good property than you will for a bad one. The income and expenses associated with that asset are likely to be materially the same. good property versus a bad property. The big difference between good and bad is really capital growth. And so really there's three factors then we need to think about that are going to be primarily responsible for driving capital growth. The first one is land value. So we all know that land appreciates where buildings depreciate. Therefore, it stands to reason that you should invest in properties that are mostly land value, which typically includes houses and older style apartments, situations where the building value has kind of depreciated to an extent that it's unlikely to appreciate much in the future. Whereas newly built properties, typically what you're paying for is mostly building value, and therefore you're going to have some big depreciation in those initial years. Now, the appreciation in land value needs to be more than the depreciation in building value to offset it, so that you get an overall increase in property value. But if your property is mostly, say, 80% building value, then 80% of your asset is depreciating, and only 20% being the land value is appreciating. That is unlikely to happen. So common sense stands to reason we need a strong land value component, which again I said is mostly houses or older style apartments. The second thing we need to look for is scarcity. We need scarcity in two ways. First, in terms of location, and then in terms of property type. So location, a scarce location is one that has a finite amount of land, really no vacant land if you like, and there's no vacant land adjoining the suburb either, and possibly even 2 or 3 suburbs over. So there's really a scarcity of additional land. And then the location is highly desirable by a broad spectrums of demographics. So, young people, families, retirees, it has wide appeal by a number of different sources there. So that's scarcity in terms of location, and then you want scarcity in terms of property type. So that means it has limited, even falling supply, but wide appeal. So a good example of a scarce property type is a Victorian cottage. No one's building them anymore, and they tend to have wide appeal. An example of a property type that has little scarcity is high-rise apartment. There's literally thousands of them, hundreds and thousands of them, and they all look almost the same. And the last one is proven performance. So really it's about looking at the past growth of the particular property and seeing how its value has changed over the past 10, 20 or 30 years. And what you can then do is work out what is that capital growth rate in percentage terms over that period of time. Past performance is often a good indicator because the value drivers associated with property tend to be static, that is, they rarely change, and factual, that they're not open to a lot of subjectivity. For example, positive amenities such as shopping strips, schools and hospitals, that make a location highly desirable, they're static, so they often don't change, or they can take many decades to change, and they're factual. There's a school, there's a hospital. It's not a question of my subjective opinion. So they're the three things, three really important things when looking at a property investment: land value, scarcity, and past performance. But they're all property specific factors. So what are the non-property specific? So the macro level factors that that are important to take into account, that you're most likely to read about in the press. And I reckon there's only a handful. In fact, I could only think of 4. There may be smaller ones that I haven't thought about. The 4 main ones. The first one is population growth. It's a very important factor because there's only a limited amount of dwellings in an investment grade location. So particularly if we're looking at houses, you can't really change the supply of houses in a location. There's one house per block. Often in blue chip suburbs, they're not really open to a lot of subdivision because the value of the land is just too expensive, so it doesn't make it worthwhile. It's not viable for developers. So quite often you don't get a lot of subdivision in blue chip locations. So therefore it's hard to change the supply of houses. You can certainly change the supply of apartments, and that's been happening, but that'll only happen to a certain amount of density. But if population is growing, then demand will be increasing, and this translates, increase in demand where supply is fixed translates into upward price growth pressure. That's Economics 101. Natural changes in population, so births and deaths, are relatively stable. They're not really changing very much and relatively predictable. The main changes will be really driven by overseas and interstate migration, and some capital cities and some locations are projected or forecast to benefit from higher levels of migration than others. So, for example, Melbourne and Brisbane are positive benefactors from interstate migration, whereas Sydney is not. And for example, the ABS is predicting that Melbourne will be Australia's largest capital city, surpassing Sydney by year 2031. So only about 12 years away from that perspective. So there's a lot of population growth. We all need to live somewhere. As the cities become more and more congested, it becomes even more desirable to live closer to the city. So those inner ring suburbs start to really become more and more valuable, I think. The second thing is money supply. So flow of money into the property market will have an impact on growth rates. So money can flow into a property market in really two ways. Borrowings and overseas sources, so that's really non-resident investors. And it's been well documented that the government has, tightened restrictions in both these capacities. So really non-resident investors have almost all but disappeared. There's still some, obviously, but certainly volume has greatly reduced. We've talked about changes in banking rules and credit and so forth, and that's been restricted. So arguably the government's been too aggressive in that regard, and I predict that lending policies will gradually loosen over the next few years, not months, but years. It'll take a bit of time. Probably won't get back to where we were. But I don't think money supply is going to be a major restrictor in the long run, but I think it will be a restrictor in the short term. The third consideration is diversified employment opportunities. So therefore, you want to invest in locations where no particular employment industry, can materially manipulate the demand for property. And therefore, demand is sustainable and stable. That's what you really want. A good example of that not happening is Perth, where, the mining boom happened, wanted to employ a whole bunch of people and bring them into Perth. That changed the property market. When demand fell back, the property prices followed. We don't want to invest. We want to invest where there's no one dominant industry. I mean, every location has a dominant industry. There needs to be a number one, but not to the extent where it can materially change the demand for property. And the last factor is really infrastructure. And infrastructure is important only to the extent that it can reduce the impact of living further away from the CBD. So really in those outer suburbs. That includes kind of reduced travel times, for example, equal access to employment opportunities, recreational resources, and those sorts of things. But as I did a podcast a few months ago in relation to this, and certainly blogs on our website, that, Australia isn't going to make, in my opinion, any material advancements in this regard. It would require an unbelievable expenditure on infrastructure to be able to achieve that. So that is that if I lived, 30 to 40, 50 Ks out of the CBD, that, is just as good or almost just as good as living, say, 10 Ks out of the CBD. That requires a lot of infrastructure. I don't think that's going to happen. And I think that's why inner city blue chip suburbs will continue to outperform, and probably more so as our cities get more and more congested. So therefore, there you go. Apart from those factors, which is really population growth, money supply, diversified employment opportunities and infrastructure, apart from commentary in relation to those macroeconomic factors, everything else is really just noise, and you should be really careful about letting that sort of noise influence your personal property investment decisions. A lot of quality media is thought-provoking and interesting. It's just that it's not that helpful when it comes to investment decisions. Topics like interest rates, construction, unemployment, all these sorts of things, they're very cyclical elements, short-term elements that might have an impact at a macroeconomic level from property, but but aren't going to impact the demand and supply or the growth of a specific asset in an investment grade location. And you'd be doing yourself a great service to really just ignoring that sort of noise. It's interesting, but you know that, look, it's really not going to be that relevant in making an investment decision. So that's it for this week. Thank you very much for listening. If you enjoyed the podcast, I really would love it if you could share with friends and family. The more that listen, the better, obviously, if you think it's going to be of value to them. But until next week, bye for now. Thanks a lot.